Welcome to our daily Forex trading strategy session. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com. You probably also know me from FXBootcamp.com. We do these sessions every Friday. This is a new event here at FX Street. And a little birdie landed on my shoulder yesterday and told me that it was the most popular webinar of last week. Our last Friday event, is that right? Holy smokes, for a brand new webinar, that is awesome. And if that's true, and even if it's not true, even if it's close, I want to thank you for your loyalty because it's not me, it's you, babe. It's not me, it's you. So that's really cool because this is a brand new event. It's fairly common for non-farm payrolls live, but for a regular old Friday, you know, it's not the best time slot. It's not the best day of the week. So if it's the most followed, then fantastic. Thank you very much for your loyalty. We also do these events every single day, Monday through Thursday at tradersway.com. Just swing on by. To attend, you need an account. So open a demo account, fund a live account, and we do these things every single day. Hope to see you there. When I'm done on Monday through Thursday, when I'm done the event, I immediately upload the video to YouTube. So every day I upload, it's about an hour and 10 minutes on average, the video. So if you miss something, if you miss the event, but you want to catch the recording, it's at youtube.com/c/tradersway. We do a lot of technical and fundamental analysis, but I might just suddenly burst out into a moment of genius and discuss, how a commercial banker would run his balance sheet, or how an analyst would value a stock, or bust out some mathematics, or like the other day, China adjusted their reserve requirement ratio, and we busted out the mathematics to figure out how this would impact money supply specifically, and whether so you understood the magnitude of China requirement ratio by 1%. I mean, who cares? If you don't get it, you're like, well, okay, I don't even understand what that is. What's the big deal? No, you bust out the mathematics of it, and suddenly, holy smokes, it's a massive deal. But it's nice to know. So anyways, those get recorded and put in there. Hey, guess what? Overnight, we got some, decent China news, huh? Second straight month in a row. Let me tell you, the way that this one's measured is anything less than 50, the economy is contracting. Anything above 50, the market is expanding. Now, typically you would see something like this at like 63, 73. But by magic, right? By magic, it's 50.1. Now, all right, come on, just between you and I, let's think about it. You have a multi-trillion-dollar economy. Do you honestly believe the statisticians are so accurate and precise that they know the difference between 50.0 and 50.1? Like, it's absurd. But magically, the market didn't contrast. I mean, seriously, like, why do they even have it? Like, I doubt they know the difference between 50 and 51, yet alone 50.0 versus, 50.1. But anyways, hey, guess what? The economy didn't contract. Yeah, sure, right. China's in a world of hurt. But what have we been talking about at these events and the non-farm payrolls events for many, many months? One, Europe needs to wake up and save itself. And it did. It developed some quantitative easing. Over a period of time, that free money, and this comes through the fractional reserve banking system and the money multiplier equation, eventually this money will stream through the whole entire economy until it goes into the average Juan's bank account in Europe. And everybody, including Juan, decides to buy something made in China. Okay? So the Chinese economy starts to improve. That's what we want to see. Okay? This would also benefit Canada and Australia and New Zealand as commodity currencies. But it would also benefit the United States if the whole world was recovering, so on and so forth. So this QE was important because remember, we needed quantitative easing out of the United States, quantitative easing out of Japan. Finally, let's get Europe on board. We had to change some rules over there. Good job, Draghi. And so anyways, we're not necessarily seeing the numbers here yet because, I think a lot of us could feel that it could be 49.9. Like, I would not be shocked that the Chinese economy is technically contracting. I mean, it kind of makes sense, right? But anyways, China's saying that it's not contracting, it's flat. Okay, good job. But eventually, Europe will recover. Eventually, China will stabilize, so on and so forth. So as China's economy is contracting, what they're doing is adding to the money supply. They're cutting interest rates. And then you get places like Thailand just the other day slashed interest rates again. Why? Because that's what China's doing. And Thailand has to compete with China for some of its business, like manufacturing and exports. So a falling or a lowering tide, right? A falling tide lowers all ships. Right now, that's the mood that's going on in Asia. But as Europe comes back on board, eventually it'll go back the other way, and the tide will rise again. You like the fundies? Yeah, me too. Unemployment 3.4% in Japan. Amazing, huh? CPI improved month over month out of Japan. Isn't that cool? It's above zero. What a world we live in, isn't it? What a world. What a life. I'm in love. Yeah. Wage data comes in soft. That's no good. You know what I was hoping to hear yesterday and today? Quantitative stimulus and stuff out of Japan. No, didn't get it. They're not hitting their targets, guys. So I'd like either the government jump in and add a fiscal stimulus, or the Bank of Japan to come in and do more quantitative easing or something, or both. Now think about it. Abe was supposed to do a bunch of things, and one of them was reform the government, and that's very difficult. So that hasn't happened. So might as well go back to what has been working, right? And I don't know why they raised taxes a year ago. It screwed everything up again. But that's the history of Japan when it comes to managing their economy over the last 30 years. Was do something drastic, improve the economy, and as soon as there's a slight sign of recovery, do something to crush it again. I don't know what it is. I don't know. I don't get it. The Japanese are very smart, very focused, disciplined people. As a society in general, if you can speak so broadly. But why they do that, I don't know. Where's YJ? He should speak for the entire Japanese culture. UK manufacturing PMI misses. Wah, wah, wah. Okay. But this is funny, right? They were thinking almost 55, didn't even get 52. Oh, but we're above 50. Well, dude, above 50, to even be worried about that is pathetic. But that's not good, right? 52? 52 is not good. Eric speaking for all of Japan. Good. Yeah, we'll do that, Jenny. Now, remember, Jenny, when I give you advice, the advice is always going to be how to lower your risk. So if you missed a trade because you asked me for advice, like, should you do something? Well, as you know, I'll never tell you whether you should do something. That's your decision. But if we go over a trade plan, I'm usually going to show you the more conservative entry. So like you could just aggressively sell off of resistance level. I'm always going to show you to wait for the reversal pattern. And when you're conservative, sometimes you miss aggressive entries. Like every once in a while, you do get a V-shaped reversal. You couldn't plan on that, but you could bet on it. So if that was the case, then so be it. I gave you the more conservative entry or discussed how to wait for a more conservative entry. And if that conservatism missed yesterday's trade or today's trade, well, that's the whole point. On the long run, being more conservative is going to keep you out of trouble. In the long run, that's going to be more profitable. If you missed a trade that you could have made some money today, well, that's fine. But what you're missing is, the 9 other trades over the course of the next 3 years where you would have lost money. But you can't see that on a day-to-day business, So, anyways, I'll be happy to cover that. Okay, what else going on? Just want to give you some snapshots and stuff. UK missed everything today. Wah, wah, wah. Look at Japanese April's vehicle sales. Last month, minus 13. This month, plus 5. Probably had to do with the weather. A Canadian rating agency stated that it saw no sovereign rating change for the UK. Good. Sweden still wants to create jobs. Yeah. Why? Because everyone's going to Norway. Graduate from college in Sweden, go to Norway. Apparently you can make like at least double if you're a Swede by just moving next door to Norway. I got a private message. If you can send them publicly, I'd appreciate it. Oh, Yen Yen too. Jenny and I can't see the other. Ask publicly, please. So I was commenting on Jenny. She wanted to know the pound dollar, and she might have missed a trade. That's why I made that other comment. And another comment on time of day in regards to the U.S. session. Sure, I'll be happy to do that. Anyways, the BOJ noted that they're helping, but they're not getting the full results. Further rise in inflation expectation is needed to hit their 2%. So I'm hoping they're setting the stage to add some sort of stimulus or something to kickstart their economy again. Okay, here's a proprietary tool of mine, not of Trader's Way, but of mine. But what these are I created indices or indexes for the currency pairs I like to trade. So the top one here is the British pound versus everything. British pound currently is very weak. The next one is euro. Oh, by the way, the time frame is 1 hour on these things. So, this would be looking at the last couple of days worth of price action, right? So British pound currently, over the last several hours, is very weak versus every other currency. So I've created a basket of currencies versus the pound, okay? And then made an index out of that. So British pound very, very weak versus everything. Euro is quite strong versus everything. This is Swiss franc here. And it was down, it was up, a little down. So I would say generally weak. This is the Japanese yen. Very weak. Japanese yen, very weak. US dollar, very weak. Aussie dollar, very weak. Canadian dollar, very weak. And Kiwi dollar, very weak. So the theme here is there's still lots of offsetting of the Euro USD short. I think if you look at the commitment of traders report, by the way, if you attend my Monday session at tradersway.com, every Monday we review the calendar for the week, and we also review the commitment of traders report to look at large speculative hedge fund positions in the market and how they're changing. What's important is how they're changing, right? And what we're seeing currently is that this big move in euro is not people buying euro, but people getting out of their euro shorts. And it has nothing to do with euro shorts. It has to do with too many people betting long on the US dollar. Why would they do that? Because they were wrong on their guess when the Fed would raise interest rates. And when the way that professionals work is if they think the Fed, for example, is going to raise interest rates, and this is true of many different event-driven type strategies, if you think something's going to happen in the future and you're quite certain of it, then you can bet on that now so that when it happens, you get paid. Sort of buy the rumor, sell the news type thing. Have you ever seen like great news and you get a spike and then a complete reversal? Why does that happen? Because people were in it 3 or 4 or 5 days earlier, and they made their money on the spike and they're out. So it in effect, it already happened. So a lot of people are just flat out wrong. How did they come to this conclusion? I have no idea, because there was nothing that I saw, and I like to look at a lot of stuff. There's nothing that I saw that suggested a spring or even a summer Fed hike. So they were wrong. That's it. That's all they were. They were just simply wrong. And so now they got to get out of those positions and rebalance their portfolios. It's not crazy. So again, okay, Morgan's asking, why is the euro strong through QE? Listen to what I'm saying. It has nothing to do with euro. This is not a euro story. So you look at this euro strong. Well, not really. Why? Again, the euro's weak because of quantitative easing. We knew that. That's fine. That's all legit. That's fine. That's all good. But too many people were long US dollar. It had nothing to do with being short euro. That's fine. But the vast, vast majority of the euro shorts also went into US dollar. And then it was a perfect storm because traders also thought, incorrectly of course, but market participants thought the Fed was going to raise interest rates soon. Right? March and then June, and if not June, then September. And they're rolling over to the next meeting every time. But they were incorrect on the buying dollar part. They were correct on the sell the euro part, but they were incorrect on the buy the dollar part. And so the euro USD had just fallen too far too fast. Now they're getting new information. This is part of the efficient market hypotheses. They're getting new information. They're finding out the Fed may not raise interest rates sooner. It's probably going to be later. So they need to readjust their expectations and rebalance their portfolio. And they were just too heavy dollar. That's all. It's more of a dollar weakness story. Okay, so, in that case, next week, euro probably weaken. Well, look at the trend. This is now technical analysis. Now we're not talking fundies anymore. You say, well, next week, euro probably weaken then? Well, first of all, it's been weakening it's moved 1,000 pips. Right, let's just generalize here. It was 105, it's come up almost 1,000 pips. When is enough? Well, that's the $1 million question. You get that right, you become a millionaire. Assuming you have money to spend, right? Right? But, that's the question. So how do you answer, well, how far is enough? Well, what you're asking is, when will market participants have rebalanced their portfolio appropriately? Well, how the hell would I know? How would you know? So this is where you use technical analysis. Identify the levels of resistance, look for reversal patterns, watch commitment of traders to see when they put their short trades back on, so on and so forth. See, commitment of traders report will show you that nobody's buying euro, but lots of people are getting out of their shorts. Well, what happens when they start adding to their short positions again? Well, now you know the hedge funds are shorting again. They rebalanced, and now they're going to bet on a new Fed hike. Quantitative easing is already in the cards. It's already priced in. So what was mispriced? The Fed hike. So as soon as they say, well, okay, it's not June, let's fade up through summer, and then let's start shorting. Let's say it could even be August. I'd like it to be today, but it could be August, and then all of a sudden in August they say, you know what, we're going to start front-running the September Fed hike. Dollar starts getting ripper strong again. Okay? So guess what? This is why if you're going to be a long-term, conservative, successful foreign currency trader, you need to have a strong understanding of fundamentals and technicals. Being a genius in one or the other only is probably not enough in my humble opinion. Okay? A good, solid understanding of both. And that's what's happening right now. So you're like, so is the euro going to go up next week? Well, I don't know, because I can't tell you when everyone's going to be properly balanced in their portfolios, but you can use technical analysis. Right now, the trend is still up, but that can change. Okay, so what could change it? How about more events, more information, right? Remember, price reflects all known information according to efficient market hypotheses. Now, the part that I don't like about the EMS is that EMS will say technical analysis and fundamental analysis is completely worthless. So we can debate all day, because I always get people debating, Wayne, you know, you don't need fundamentals, it's all technicals. You know, and then you get people like George Soros and other actual people that actually make billions of dollars a year, and you know, the whole professional trading industry. A huge amount of them do not use technical analysis. So they could argue against you. Oh, it's all fundamentals, technicals, blah, blah, blah. EMS guys will say fundamentals and technicals are both worthless because everything is appropriately priced, and that the market is logical, and therefore all known information is out there, and it'll never be mispriced, because if it's mispriced, people will arbitrage that immediately, and it'll automatically readjust. EMH. Efficient market hypotheses, which I think is a joke. So you need to pick your place. So what I'm telling you is all known information is included, okay? I think you need technical and fundamental analysis, and that I know the vast majority of the market participants are not rational. In fact, a big chunk of them are just flat out stupid. So there's lots of opportunity to make money. A pure EMH person will say there's no opportunity to make money unless you add risk. And that's the only way to do it. If the market's going to go up 5% and you want to beat the market, add leverage and you'll get 10%. But the beta of the market's only up 5 and your alpha's 5, but you had to double your leverage to get that. So you're not any smarter, you just took more risk. And I can see parts of that. So, you know, you need to know where you stand. So anyways, you want to change the value of currency? Add to the information, okay? So what's coming up? We have consumer sentiment today, ISM manufacturing. Okay, that's going to be good. ISM manufacturing, obviously we have a service economy. But with quantitative easing been going on, had gone for quite some time, and now we're done. What I want to see is good numbers out of manufacturing, not necessarily as jobs. But I like to use. You think I'm, but I know a guy, or stepfather. Yes, stepfather. Yeah, and he works for them, and they own a huge shipping company. They have warehouses. They have forklift drivers that make $22,000 a year and drive brand new Cadillac Escalades. So I want to see if that money that the Fed added from bond purchases, that the money went to the bond dealers and it went to the bond dealers account and then and at the bank, and then the bank took that money and started lending that out, and that money went to other places and lent out, and so on and so forth. Eventually, I want to know if the guy at the, dare I say, the bottom of the food chain is driving, a Hyundai Excel from 1997 with 375,000 miles on it and broken window roller downer things, or if he's driving a brand new Cadillac Escalade because he can lease it, because he's got a job, because credit's flowing. He might be leveraged up to the hilt, but homie don't care about that, right? So it's all good. So I like to look at that as trickle down, right? Right? It's trickle down economics that I'm using ISM manufacturing for now. Now, I've never, that isn't always the case, but over the last few years. So let me change the point of view, and then we'll get right into the charts and do some technicals, all right? So let's look at Europe now. We've started this journey of quantitative easing. When does it actually stabilize the economy? The first day? Draghi buys $100 billion worth, 100 billion euros worth of bonds. You're European. When do you get rich? Now, let's see, if you were smart and I told you to just buy the DAX, buy the just buy the stock market. By the way, I hope you guys remember about 5 years ago, I showed you the Spanish stock market, since FX Street is in Spain. We looked at it. It was at a 786. It was an 80% retracement. And I said, how many people think the Spanish stock market's going to go to zero? And nobody said that. So I said, then why don't you just buy it and give it to your children when they graduate from college? Here's the entire Spanish stock market that you bought at 80% off. Super sale. Nobody took me up on it, of course. But anyways, so when will quantitative easing hit the average guy? The average Juan and Johan. The average Johan. When? How do you know? That's where you got to look a little deeper into the micros, right? The microeconomics. And that's what I'm using ISM manufacturing for. When do you see wage growth there? Okay? Because when you're measuring consumer spending and consumer confidence, whose confidence are you measuring? Of a bank? No, see, it's not when QE starts, okay? If you're the CEO of a bank and QE starts and you're front running your central bank, because remember, the bank, in this case the ECB doesn't go to the treasury of a government and say, hey, Germany, sell us some bonds. What do? They contact a bond dealer, a broker. They just go to so let's say you're the head of Deutsche Bank now. That's where the ECB gets their bonds. Not the Bundesbank, right? They call it Deutsche Bank. And they're like, hey, Deutsche Bank, we'd like to buy $100 billion worth of bonds. Guess what? Head of Deutsche Bank now gets a helicopter to fly to work because of the commission they're going to make on this. Okay? So it affects the bank. But then what? Then the bank lends that money out. To whom? I don't know, a business. And the business then, let's say, builds a factory. So they hire a construction company, they buy some land, right? So they buy some land, they give it the money now to the person who owned the land. And the guy that got the money for the sale of his land puts it into a bank. Then the bank takes that and lends that out. Meanwhile, they have to hire a construction company. The construction company hires a bunch of workers and starts to buy material. So the workers get paychecks. They put that money into the bank. The material company gets the order, sends an invoice, collects money, that goes into their bank, and so on and so forth. And you have to, like, when does it get to the average Joe? Because eventually the construction company guy, he gets paid, then he goes to the store, and now the store clerk has a job, and she gets money, and then she pays the babysitter, and the babysitter buys, crack cocaine, and the drug dealer makes some money, and yeah, it all works. So you have to that's the trickle-down effect that I'm looking for. Okay, so it's not as soon, and then if you can track that far, when does Europe stabilize? And that could take 9 to 12 months in my guess. When that starts to stabilize, then China will stabilize. And when China stabilizes, Australia will stabilize, and so on and so forth, okay? And then here's a bunch of PMI stuff coming up next week. Factory orders, that'll be interesting. IV PMI, that's going to also be interesting. You guys ready for some technicals? Yeah. Cool. All right, let's. I'd like to do a quick survey. Okay, I'd like to do a quick survey because I'm here to serve you. You're the boss. I'm just a humble currency trader. I'm donating my time and my experience to help you become a success. So if I deviate from what you need and want, then it's sort of a disservice to everybody. Was that too much on the fundamentals and sort of discussion of market sentiment? Or was that enough, and then we can do, we still have, I think, 45 minutes to do technical analysis purely. Okay? I like to talk with you guys because telling you is not a learning experience. This is a 75-minute webinar. Okay? But I do like to talk with you guys. I like to, I think it's a collaborative process. Okay? If you work for me and, I would have at least weekly, probably a couple of times a week, where we would have a team meeting. We'd come in and we'd discuss things. And so this is sort of our team meeting. You and I as, comrades, right? We can collaborate. So that's where I go with that. So I hope you enjoy it. Okay? All right. So somebody asked about Euro USD going up next week. Okay, this is Euro USD. What's the trend? Technically. Okay. So here's my theory. Until it reverses, it will go up. Has it reversed? No. It will go up. That's it. If you sold this, what are you doing? You bet. You're betting. Okay. Do I want traders to bet? No. No. Nope. So you need to stay bullish until it turns bearish. What would a bearish turn look like? How about something simple like this? Lower than that low, lower than that high. Wrong one. Sorry. My bad. Apologize. Lower than that low. Done. Now I'm a bear. Now, am I a long-term bear or a short-term bear based on fundamentals? Okay. So basically, I'm going to try to swing this down. And I can see technically I'm a bull here, so I want to spot this up or day trade this up. So let's just talk about the difference here. How about you made one trade per day? Okay. You buy it at the beginning of the day, you close it at the end of the day. Because if you're a bear, you think, well, it's very bullish, but I'd like it to fall at 111. I'd like it to fall at 112. I'd like it to fall at 113. So you're kind of like, you think the fall is coming up, but it's still technically bullish. So you're not going to be long that long, right? You're going to be long, let's say, for the day, but you're hoping today, part of the day, it actually starts to reverse. And remember, before it reverses, it's probably going to consolidate. Right, Jenny? So you're bullish for the day, but when it does become bearish, remember, now you need a technical reversal for it to do that. But once the market has turned bearish in congruency with your fundamental bias, then what if you made a trade and held it for the week? You're in at Monday or Tuesday, and you're going to close it on Friday. Up for the day, down for the week. Up for the day, down for the week. Up. But you're not selling until the market, the technical market, agrees with your fundamental bias. If you agree, say aye. Okay, cool. So you know what this is? If we can get the market to work, and I don't know if it's going to work soon, but here's my hope. I'd like to help you get your first 1,000 pip trade. Okay? And you say, Wayne helped me on that one. Like, you just know it. You're like, you got the 1,000 pips, but it was something that I did to help you. And you believe that. Like, that's it. So maybe, just maybe, it's this Euro USD trade. And that, in fact, instead of holding short for a week, what you end up doing is you take the shot, and it doesn't have to, I don't want you to take the shot at the top. I want it to make the lower low, lower high, lower low. So, you get a scenario, maybe it's even, a day or two later, and it does another pullback, and you short the next one. So I'm not even asking you to be smarter than the market. I just want you to be in the market. Okay, and you're short there. And over the next few days, like it makes a lower low like this, makes another lower high, and doesn't take you out and down. That you leave a trade in there and you try to get the 1,000 pips. No, I don't want you to take it. I don't want you to take risk. I want you to take opportunity cost. And the difference is your stop's at break even, and you're practicing something specific. One, a technical entry on confirmed reversal of trend. And two, position trade. You need to say to yourself, even if you're up 450 pips, you're practicing a position trade. Okay? In this case, it's almost a carry trade, but there's very few real carries, at the moment. But I want you to say, like, it's a mental. It's a mental decision process that I want you to practice. You say, I believe this is going to fall a lot from, where are we now, 112 something to parity. And I want you to practice that. You say, this is going down to parity. I have a position in. I've moved the stop to break even, and I'm going to let it run. Now, the quicker way to make 1,000 pips on a trading idea is to short every pullback so that, you make 333 pips on 3 trades. Right? 250 pips on 4 trades, and that would be, and it's even faster than that because the first one you might be up 400 pips, the second one 300 pips, right? The next one 200 pips, the next one 100 pips, and that's 1,000 pips. And it's the same idea. You're now building positions. And you could do it that way too because it's the same idea. You're adding. Okay, and the way that I would add, you can't do it in the United States, skull dang it, because the stupid government forces your broker to, dollar cost average your trades. So instead of being in 2 unique trades, one has 400 pips profit and the other one has 200 pips profit, no, you have one position at double size with an average of 300 pips. And it's just a horrible, horrible, dumb idea. But that's the government for you. Right? So what that does is you cannot carry trade anymore. So think about all the yens moving up. You cannot be in 5 USD yen longs, 3 pound yen longs, 5 Kiwi yen longs, right? And then manage each position individually by moving your stops. You can't do that if you're an American. Now, why does the U.S. government not want you to make long-term investments? I don't know. I don't understand that one. It just has never been explained to me in a proper way for me to understand. And I'm not that stupid. Why would you not be allowed to make long-term investments? Don't know. And then the whole thing about hedge. Well, see, I thought long-term investments allowed you sort of to make sound, safe investments. And being in multiple trades just allows you to manage the risk more properly. And then hedging, isn't hedging about reducing your risk? So that you're not allowed to make long-term investments and you can't hedge your risk? I don't get it. But anyways. So if you work with me, guys, let's over the next few weeks look for a scenario like this. And if you want to make that decision to practice and one way or the other, to be either to build a position or make an investment, because that's what it is now. If you are short at 112 and your target is parity, we're talking 1,200 pips. And that's going to take a while. I mean, it could take all summer and then some. It might take now to Christmas. Right? So that would be an investment. But move your stop, remove the risk. It costs you nothing except opportunity cost. If you're up 500 pips and it comes back and knocks you out of break even, opportunity cost. Learn from the experience and try again. All right. So that's Euro USD. That's kind of what I'm looking for in the longer term. So is it going to go up next week? Well, it hasn't reversed. So if you're a bear, let it reverse. So up for the day, down for the week. Does everybody understand that concept? Right? Is it going to go up for the week? Well, that's how I would trade it if I were me. Okay? Up for the day, down for the week. Don't sell in a bullish market. If everyone agrees, say aye. Don't sell in a bullish market. Aye. Don't sell in a bullish market. Don't sell in a bullish market. Yeah, okay. So I promised Jenny from the block we'll do some pig dog. Okay. So this is what Jen was commenting on. We had this discussion yesterday. Do you sell at the double top? And we were in this area right here at that particular time. Okay, right in there. And I suggested down to the 21, up for a triple top, and then down. Okay, what it's done is down to the 21, but remember the 21 was down over here at that time, so we were guessing where it was. Up, right, to a triple top. Well, it did come back that much, and then down. What occurred 6 hours ago? What occurred about 6 hours ago? 5 or 6 hours ago. 1 4-hour candle, plus this one's still open. What occurred around, approximately less than 6 hours ago, but more than 4 hours? London Open. Okay. What was the retracement? It was a 50% retracement. Okay. When you're measuring to look to sell, you measure somewhere between the 382 and 618 Fibonacci retracement as your sweet spot. I've been teaching that for 10 years. Lower low, right? For those that have been following me more recently, when I say hammock, what do you do? Hammock. When I say the word hammock, what do you do? Yeah, wake up, go to the fight. How? Tell me specifically. Come on, I want to see if you've been trained yet. What do you do when I say hammock? Come on, guys, tell me specifically. Don't give me like vague answers. What you're telling me is some people kind of know, a lot of people don't know. Get up and without hitting your head. Yes, that's the right story. No, it's not fib wars per se. Yeah, you should be in automatic mode. All of that's right. But tell me, what do you do? What tool do you grab? What do you measure? And what is the trade setup? And for those that don't know what I'm talking about, here's the idea. I've been trying to drill through regiment this idea that when you see a change in trend, you change your strategy. Okay? And the regiment idea is like having like drills, right? Using this military theme, that if you're in the Navy, you're sleeping in the belly of a battleship in your hammock. And I laugh because I don't know if they're in hammocks anymore. But you're in the belly of the ship. It's the middle of the night, and all of a sudden the alarms go off. And you get up, right? And get up, and the alarms are going off. And you got to get out of your hammock, run down the hallways. Right? This whole ship's made out of steel, and you got to duck your head under the door and everything, and run up the ladders, and get to your battle stations. Battle stations, battle stations, battle stations. And it's all crazy, right? But it's just a drill. And that if I was the captain of the ship, If I was the captain of the ship, I would do this day and night, day and night, day and night, day and night, day and night. And at some point, you'll be so good at it that next time it happens at 2 o'clock in the morning, you jump out of the bed, you run down the hallway, you duck your head under the steel door, go up the ladder, get to your station, and your eyes are still closed. That's what I want, that level of perfection. And in this case, when you get a lower low, you immediately set up your fib for a lower high, a sweet spot like this. You're going to sell somewhere between the 382 and 618 Fibonacci retracement. Now, this is using a 4-hour chart, so I'm sorry, you have to have about, you only have 8 hours to prepare. I'm sorry. It might be too quick. In this case, it was more like 12 hours, right? But what's the prime time to trade? Pre-London. 1:30 in the morning New York time. And you're at approximately, you're at a 382, and you'll see that it's spiked up to 50%. Somewhere in there, you can take a shot. Okay? So when I say hammock, I want you to visualize that you're in the belly of the battleship, and you're sleeping, and your hammock is just gently swaying to the rocking of the ship, and everything's good. And then, and you jump out of your hammock, and you run down the hallway, you duck your head under the door, climb up the ladder, get to your battle station, and you can do it with your eyes closed. And what you're actually doing is you're noticing in an uptrend a lower low. So you immediately and instantaneously say to yourself, I'm going to measure the lower low to a lower high. I'm going to bust out my fib. It's this one here. Okay? I'm going to bust out my fib, and I'm going to look for a lower high somewhere between the 382 and 618 Fibonacci retracement. You don't know exactly which, but that's where you drop into smaller time frames, but you probably know when. Okay? You probably know when. Right? Is it at the Kiwi Open or the London Open? Right? So off she goes. Hot to go, HOTTOGO. Okay? Helpful? If I ask you next week, if I see a reversal like this, I'm going to say hammock. You're going to grab your Fibonacci. You're going to study from the new direction, essentially a reversal Fibonacci study. And you're going to identify the new sweet spot for the change in trend. Right? Everybody having a good time? I call it a hammock because you're sleeping in your hammock, and you should be able to do this automatically. You should be able to do this automatically with your eyes closed, essentially, right? This is part of a drill. That you can jump out of bed without a moment's notice and automatically do the right thing. Okay? Okay. Next. Just want to kind of show you where we are in the process. Okay. I thought it would work its way up a little higher before it drops, but if it did that, then it would be a higher high. So higher low. We haven't done this yet, you notice, but I'm set for the same thing. if we made a higher high, I've already fibbed it. You see that, guys? Now, we haven't made a higher high, but I suggested if we made a higher high, then that's a confirmation of reversal of trend from a bearish trend to the bullish trend. And if it does that, I still expect a retracement, and I would buy it here. But not until we've made the higher high. You guys following? If it makes a higher high, then I'm going to buy the higher low. And we're using now daily charts, so I'm already thinking 2 weeks in advance. Nice? All right. How many people here remember discussing the British pound and using the IMF report to anticipate a change in trend as new information was added to the market to confirm what Carney was saying at the Bank of England? Okay. But it was that middle week, right? The 16th of April, right? It was that week that the report came out, but we did discuss it more than a month before, right? If you remember, Carney was saying at the Bank of England, the data's bad, but the real economy is good. Meanwhile, the British pound was falling like a ton of bricks, right? But so we guessed if the pound was going to go from technically bearish to technically bullish, that someone's going to have to confirm Carney and his point of view. And I came up with this idea that it would be the IMF World Economic Report published in the middle of April. Can anybody confirm all of that logic was clearly laid out in great detail from Carney, his opinion of the economic data, and his testimonies and his speeches, and then this conversation, discussion of he's right, he's conservative, this is why a Canadian is running the Bank of England, and if he's right, it needs confirmation, and what would possibly confirm that, and then if so, when is that information going to be made public, so on and so forth. So 6 weeks in advance, we were talking about the potential trend. Now in here, it reversed. That just happens to be the middle of April. And if you look at it at a smaller time frame, it was also a head and shoulders, inverse head and shoulders pattern here on, right in the middle, right here in the middle of April. And you can see we have it planned out like, yeah, cool. The interesting thing is that it's gone from 146 to almost 156. That's technically 1,000 pips or almost. So I don't know if I get to count that as, giving you 1,000 pip move, but I think it moved 800. Okay. Yeah, Pan wants another one. Hoo-ha! Really? 1, 2, you rock. Cool. Why don't you... Has anyone made like more than 300 pips because of something that you and I have discussed together? Anybody? How many people can say, because of something you and I discussed together, that you made more than 300 pips? Okay, a few, cool. On one trade? Not on like 9 trades. Okay. Cool. Let FX Street know. Oh, and this particular one. Cool. No, that's not what I said. But let FX Street know that what we do is useful and valuable, and that you're finding success, and that the whole point is, the mission's being achieved, so to speak. Okay? Let's do a quick track around the world. Okay. Gold is coming down. Oh, snap. Look at this guess. Okay. This is a guess. I don't believe this happened yet when we drew it. But I'm a bear. I've always been a bear. I've never been a bull. But never, I mean, I'll give you an example. Do you guys remember Todd Crosland, the former CEO and founder of IBFX? He pinged me the other day, and I'm like, man, I was in the IBFX booth at a Forex Trading Expo at some time, and I'll never forget. I had a bullhorn, and I'm in the booth on the trade show floor, not in a room for speeches and stuff, right? I'm in the trade show floor at the IBFX booth with this big chart on a giant TV screen, and I'm yelling through the bullhorn for people to buy gold. That was probably the last time. Do you know what the price of gold was? $650. Like, hey man, it was funny. IBFX days. Yeah, it went to 2,000. Yeah, I used to do these speeches. Fill your swimming pool full of oil and stuff your closets full of gold. Oil was at like $35 or something, and gold was $650. It was pretty funny. The old boot camp days. So anyways, I've always been a bear on this. I can't see any particular reason why you would want to own gold. I think there's so many better opportunities out there. The only reason you want to participate in gold is if you somehow own gold physically or want to own gold physically, that kind of thing. So that being said, I'm always looking for a bearish setup, and you can see at the top near resistance, we actually have this big drop reversal set up, and I'm very, very sure we did this before the reversal, before it actually did it. This was a guess. But anyways, it's made its way down, all the way down, and that just makes me happy. Now, with all of that being said, let me change the hours here. So you can see it here that we have all of this pretty easily set up. The caveat to this is I don't think it's going to go much lower either. Because if you're interested in trading this, you probably have an interest in physical gold. And if you have an interest in physical gold, there's a high likelihood that you actually own gold. And the closer it gets to 1,100 and then 1,000, the more likely people are going to buy it. Not because of true supply and demand, but because you actually own it, and it's sort of a hedge, and so you'll buy it simply because it's about 1,000, and 1,100 to me is about 1,000. So my guess is, sell it off the top and don't expect this to go to $650. So it's got, I think, very limited upside, but also very limited downside, and you're not collecting interest payments 7 days a week. So it's just like, I think there's better stuff going on to be trading. But I'm happy to see this go down because that makes sense. Gold typically goes up if there's, let's say, lots of demand to make stuff. But, a lot of people associate demand for gold as an inflation hedge. We don't have inflation. We're still in a deflationary world. It's actually a very serious problem. We have very serious deflation. No need to buy gold, yo. Okay? But, you know, I guess you could day trade it and stuff, but I think you could make more money on other things. And at the end of the day, that's good. Okay? This is going up. This makes me happy because I got to get it on the day chart because I want to sell it. I want this to go up so I can sell it. Isn't that funny? My madness. I want this to go up so I can sell it. Y'all. And you can see we already have it planned out. Okay, all the way up here, then all the way back down, and then a lower high, and then eventually a lower low. Okay. So that's oil. Okay. S&P 500, we had multiple plans, one for it to go up here, which it did, and then failed. You know what? We must have deleted one. I think I had another one in here. As you can see, this blue one. I thought I had a gray zone in there, but it failed. But anyways, we're sort of at the best sort of Alamo on the short term. This should go up. Okay. This should go up from here. If not, then it's going to fall way down. And I'm not emotionally ready for that. So I'd like to see in this macro move now, you know, this. Okay, we have a 3A2 Fibonacci retracement off of the all-time highs. And I'd like this to go up. And if it doesn't go up, it's going to fall quite a bit more. And, you know, where's it going to go? These sort of middle tier level fib levels, you know, no. I would expect a full reversal down into support down here. And if it does that, then we're going to consolidate for a very long time. And I just hope it doesn't do that. Okay? So if it's going to go up, let's just have it go up now, okay? Call your broker. So that's that. Now remember, more people make money when the stock market's going up than when it goes down. So if there's been profit taking on here because of the profits, maybe they reinvest back down in here, okay, on the 3A2 Fibonacci retracement. That's what I'm hoping. All right, USD Kitty Cat. We moved sideways on the USD Canadian dollar for a very long time. We were buying at the bottom, selling at the top, buying at the bottom, selling at the top. Eventually, it made a lower high, lower low, breakout. Hammock! Okay. Set the retracement, roll reversal. It didn't go down. Now, notice this is a 4-hour chart, so this lasted for days. It went from, 23 down to 20. So that it only moved 300 something pips. But the thing is, it took almost a week and a half to set it up. Because we were down here and we didn't know when it was going to retrace, and then finally it retraced, so then we measured this area and the roll reversal, and then it took many days to get up here, and then it was a sell. And it you know, we had like a week to set it up, and then it took another week or two to fall the 300 pips. So I wouldn't call it the fastest trade in the world. Most of the time here, CAD was weak and dollar was weaker. So it's not a good trade, but it very conservatively, very easily, very deliberately. Look, we don't even have pivots on here. There's no moving averages on this chart. This is pure price action. And and produced about 300. You can see we've already been anticipating a higher high. And the reason we have this as a sell zone is it's a 50% of this second move. Or 618, or let's just measure it one more time. Because I don't think it actually made that low yet. All right, so let's make it a 618. Like that. So it can go a little higher. And what I'm doing here is the new sweet spot is in here. Okay? If it breaks higher than that, then we've got to look for the macro fib, and that sweet spot's actually higher up. So if it's not going to kick off this, then I'm going to make the failure at the 382. So basically this green zone is going to be the short, the second short on the day chart. And I hope it doesn't do that. But the US dollar can get strong, sure. Oh. But we'll see then. We'll see if we need to adjust. Okay, right now, what I'm hoping is that we make this move here, 618, and then it drops. What's the target? No, what's the target? Well, look, this first move is a 382. This macro move, or somewhat macro move, that 382 predicts a 1618, and that puts us down here, 117. So hopefully these micro moves, so let's say from here to here is the new sweet spot, and let's say it does fall, okay, falls down to here, then it's going to hesitate again, right? And then it's going to come back and hit this roll reversal, and then it's going to come down to like this. Okay. I've just been told we have 5 minutes left. How can I help you guys? Any last questions? It's already been 75 minutes, but thank you to FX Street. They're squeezing in another 5 minutes. Oh, yeah. Eric, the binary stuff, you should have told me earlier. We could have scalped. Emmanuel, oh, the sell? Well, first of all, don't get all crybaby, Emmanuel, but how do you, look, this is what technical analysis is. All this stuff should be easy, so let's zoom in. Okay, on this time frame, okay, well, let's use this example here. Your trade plan very clearly is after the break, set up the retracement somewhere between the 382 and 618 Fibonacci retracement, you sell. Okay? Okay, fine. So when you get in there, get off the 4 hour, get on a 15, get on a 5. Now, obviously, I'm not going to be able to do that now because it's so far back. But now, so let's say this red zone is a sell zone. Now, on the 15-minute chart, does this look like an opportunity to sell? No. It's still bullish. I'm looking to sell somewhere in this red zone, let's say. I don't know if this is actually a proper red zone or not, but all right, but I've made the decision on a higher time frame to sell in this red zone, somewhere between the 618, the 382 and the 618. So on the 15-minute chart now, I wait for reversals. I wait for the 15-minute chart to be bearish. And then I sell. Now, this is simple fractal geometry now. I sell in a reversal zone on a higher time frame so that my 15-minute chart is now congruent with my 4 hour. And it could be the first wave 1, 2, 3, or it could be the retest. Okay? And typically, if I see this move, let's change the move here. Let's say I see that. Now that's very clearly 100% retracement of this move, which is not bullish. So I would immediately and automatically, my brain would do this. I'm going to look for the lower high because I'm already a bear on the 4-hour. And I'm going to look somewhere between the 382 and 618. That's a little too high. That's my new sell zone. And then once that's identified, so price is down here now, then I drop into a 5-minute and wait for it to roll over. I'm now in a 5-minute ready to fire for effect. Okay? Remember my book, Strategic and Tactical Forex Trading. The idea is you set up your strategy on a high time frame, and then when you got that set, you look to enter using smaller term technical analysis like that on a smaller time frame, like a 5-minute or a 15-minute. And I'm simply selling in a bearish zone on a higher time frame, but I'm scalping on a low time frame. Easy, right? All right. Thank you to FX Street for being wonderful hosts. Thank you for your loyalty and coming here today or watching the videos. Be great if you can interact, and if you're enjoying these, let FX Street know that this is a valuable use of our time. If you're having success stories, I would like to hear it. So again, share it with FX Street. Let us know that that these events are helpful and that that you're benefiting from them, because it does take a lot of time and energy on everybody's part. So it's good to know that you care.